This after the Dow, S&P, NASDAQ all having their worst year since 2008. Here now, joining me is Market Compass founder and CEO Amelia Bourdeau. Good to see you.
Hi, good to see you too.
Nice to see you. What to make of these markets going into the new year?
It's a very exciting time. Volatility is going to stay very high. It's above 35 right now on the VIX, and I don't see that coming down any. As you were referencing a few minutes ago, there's just a lot of event risk coming, which is exciting because it's going to really provide a map for investors in terms of timing the market. And we have the China trade tariff issue negotiations going on. We also have coming up the second week of January a vote in the UK on whether or not the parliament there will accept Theresa May's Brexit deal. And of course, that caused a lot of turmoil back in December. So will that be a replay, in 2 weeks' time? And then, of course, at the end of March, we have a possible hard exit, the UK leaving the European Union. And the Bank of England had put out a report in late November, a financial stability report showing what would happen if a hard exit were to occur. And they're forecasting perhaps the pound to go down to parity with the dollar. Just really destabilization across markets. We're looking at a lot of volatility.
Europe is really interesting, I think, because what really happened last year was the euro crisis kind of moved to the heart of Europe, because even beyond Brexit, you've got the situation in France right now, which is fairly delicate for the president. And even in Germany, you've got the prospect of very tentative government looming over Germany. So I would think Europe, even beyond Brexit, is going to be something you're going to have to watch pretty closely all year.
I agree. And Europe also is slowing down. We have U.S. growth starting to slow as well. And just turning back to the Fed, I know you were talking about that. The Fed is moving to a press conference at every meeting starting this year in January. And that raises the stakes for an error in communication, or perhaps the market doesn't like the communication that Powell is putting forward.
How do you think about the U.S. economy and its strength going into the new year relative to these other kind of macro global issues?
I want you to answer that, but I'll point out that the jobs report is out this Friday, even though it's a shortened holiday week. 177,000 jobs is the expectation. That would be a little bit faster. Disappointment in November with 155,000 jobs added. The unemployment rate still at 3.7%. An economy that is expected on a calendar year, expected to grow at 3% or greater, which we haven't seen since 2005.
Right. I think the turmoil we're seeing in the markets is a little overdone because, to your point, we still have, strong growth in the U.S. And to your point, Matt, it's still outperforming other economies, especially Europe. So that's good, and I think it'll ultimately, be good for the dollar. And I think there's a mismatch going on, and I know people have been talking about that, about what's happening in the equity market and how it's reacting and how it's falling, and the actual state of the economy, which really it's not bad enough to reflect the price action that's going on in equities right now.
But is the market volatility going to push the U.S. into a recession?
You read my mind. That's exactly right.
You can't ignore what's been happening. October to now has been nothing but rough.
Yeah, investors are scared. I think corporations are scared, too. I think it would be tremendously beneficial if we can get an answer on the China trade negotiations. I think that will calm everybody down. But to your point, you're exactly right. I mean, once investors and consumers lose confidence in the economy, they stop spending, and that's a problem.
One of the big issues with a downdraft in the market is, would it influence almost most greatly are the investment decisions by corporate executives, because they arguably would have greater exposure to the stock market as a percentage of their wealth than maybe individual investors. And so they see this downdraft in their assets or in their investments, and then that influences their decision making in terms of investment, which has been since the tax reform.
It did well at the beginning.
Right.
It's come down a little bit. And I do think the uncertainty that's hanging over the heads of everybody is a big question. I mean, we just run through them, right? The shutdown, assuming, will be resolved one way or the other. But you've still got a lot of political drama ahead of us. You've got Brexit. You've got China. You've got the economic health outside the U.S. particularly. Consumers really were feeling the wage impact last year, which should have been good, although we saw confidence wobble a bit at the end of the year. And then behind all that, even coming in 2020, Dagan, you've got a lot of corporate debt coming due.
Yeah.
So there's just a lot of things hanging over the heads of companies right now, even in a good time.
And I think rising labor costs for companies is an issue. Maybe they're getting hit with a 1-2 for like rising prices due to tariffs and rising labor costs, and that's difficult for them.
What really triggered the beginning of this slide, and I said this on Monday, once you're in a slide, everything becomes a problem. Then you start worrying about Britain and France and China and the shutdown in Washington. But what triggered the most recent slide in the fall was the jump in longer-term interest rates. They got to, I think, on the close, 3.23%. Now we have the 10-year yield falling to an 11-month low this morning. Will this give the stock market some ballast, maybe, or is it a rock rolling down a hill at this point?
It's just tough. I mean, the market is fickle and investors are fickle. They don't like uncertainty. And so what happened in early December was that's when the yield curve inverted. And so longer yields came down.
2, 3, and 5,
yeah.
but not on the 2 and the 10.
That's true, not on the 2 and the 10.
Where shorter term interest rates are higher than longer term, which
that
signals.
was a bad stock market day. And now people were saying, when's the recession? Because parts of the yield curve, are inverting. And so there's no right or wrong. It's just like kind of how the market wants to read it. And right now, the market's trying to read the tea leaves in a more negative light, and that's a problem.
Give me a good jobs report, folks. Come on. Come on Friday.
Yeah, but again, it's good news, it's good news, bad news. Yeah. Really quick, I'm going to ask a classic Maria Bartiromo question. How do you allocate your money in these markets?
In these markets,
stocks versus fixed income, even sector allocations, just before you go?
It depends on if you're a more long-term value investor or not. If you are, I would definitely try to buy here and allocate into sectors. I would actually try to pick up some tech. I would actually try to pick up some, major U.S. corporations staying out of the housing sector for sure. It's just that that's a more longer-term perspective. Right now, we're in a trader's market, so if you only have like a 1 or 2 month horizon, that's not going to work for you, and you should be allocating into the fixed income market.
Amelia, great to see you.
Nice to see you too.
Thank you so much.
Happy New Year. Also.
Yes, exactly. Please come back much in the new year.